This study is called time average bands, and they were created in an attempt to get over one of the problems, which is quite common with Bollinger Bands, in how you actually qualify breakouts. One of the problems with Bollinger Bands is quite often they're very good at getting a first breakout, but then it can sort of start flagging other breakouts once the trend is already developed, and they can be a little bit more problematic. If you go to my mapping, your voyage of discovery, there's a section there on Bollinger Bands and specific ways that you can use them, primarily as an exit tool to trend following, but you can use it against the trend as well. Time average bands have the ethic or the dynamic of using standard deviations, but that's really where the similarity ends. What it does is it looks at the average for the time of day in the same way as volatility time bands does, if you're looking at an intraday chart, and then takes the average of that range for that time of day, and then does I think the default is 22 days average over it. And what it does is, depending on whether the current range is expanding or contracting, which is what it should be, the moving average, which is the dashed line in the middle, will actually change in its velocity. When we're looking at historical charts, which is what we're doing here with Apple on a daily, then it's just looking at a continuous range. And the idea is that if the range is expanding, then the moving average value will fall, and the lowest it can fall is to a 3 period. If the market goes very quiet and there's not much happening in terms of range, then the average will gradually get longer, and the maximum that can go to is 21 periods. So the idea is that if we get a breakout, we should normally get some sort of expansion of range after a contraction of range, and so the bands are suddenly going to start expanding quite rapidly, and then as the trend dies or it slows down, then the bands are going to start coming back together again. And Apple here is a pretty good example. First thing is the breakout, which we have here on earnings, gaps higher, and it's above the fourth deviation. So note we're using 1, 2, 3 and 4 deviations, so a lot more than what a Bollinger Band does. Inevitably what happens is the price can never stay outside the fourth band for very long. It will always have to start coming back in, but we can understand the strength of the trend as it retreats back towards the variable moving average in the middle, and we meander higher. You can note that really we consistently hold the one standard deviation down until we start contracting again, and we did actually briefly go below the fourth deviation. If you note, with a stock that's skewed upwards, that's got stunning stats, actually looking to be possibly looking for signs of reversal if price hits the fourth deviation down, could be somewhere where you could maybe use the time continuation pattern to see if there's an opportunity to get in on a dip. The second move is here again. I think it was on earnings, and we hug the fourth deviation, so I would qualify that as a breakout as well, because we're very, very strong. And note how in a real, what I would call a very, very strong trending move, you can use the variable moving average as your trailing stop. As soon as you close below it, then you could take your out.